Imagine you're at an Apple store and you find an $800 iPhone on sale for $100. What do? You buy as many as you possibly can to make a killing on eBay, of course. That's what every rational person would do. When it comes to the stock market, however, we tend to behave irrationally. The markets sell off 10% and most of us want to run for the hills. Well, why do you invest? Do you invest to make a killing on one cool company? Do you do so to build wealth? To preserve wealth? Warren Buffett has become a national icon for his investing prowess. Buy good companies selling at discounted valuations and hold them for a very long time. That's his mantra. You see, the markets often behave irrationally, creating great buying and selling opportunities. They can make many people wealthy and leave many others poor. Warren Buffett has become a great investor not only because he got lucky or stayed invested long enough, but rather because he had a consistent philosophy that he stuck to throughout his life. When the markets became expensive, he'd sell. When they became cheap, he'd buy. Most people, they do the complete opposite. That leads me to the topic of this video, investing versus gambling. What really is the difference? To me, gambling is having no plan in place and hoping for a positive outcome based on something completely out of our control. Buy and hope. Investing, conversely, is having a focused, consistent strategy to accumulate and preserve wealth over time. If you're invested in the stock market but have no idea why, you're gambling. If you have an advisor who has no basis on which to enter and exit the market, you're gambling. Conversely, if you're a poker player with prudent risk management and clear exit and entry strategies, you're an investor. Ask yourself, why are you invested in the market? Are you trying to mimic Warren Buffett's success? Are you buying on a tip from Jim Cramer, or a friend, or some random message board? Or because your advisor said that there was never a better time to be invested? Well, what will you do when the market drops 10%? What about 50% or more? Will you run for the hills or want to buy more? What will your decision be based on? The average person invested in the stock market underperforms even the basic index. Many lose money altogether. Likewise, the average person loses money in a casino because the deck is stacked against him. Investing, therefore, is no different than gambling if your odds of losing outweigh your odds of winning. Bottom line is, before you invest, make sure you have a core investment philosophy. Have a risk management system in place. Know your entry and exit points, your time frame, and ultimately what you're trying to accomplish. Otherwise, you're just gambling.